Alright, so now let's start the chapter 5. So chapter 5 is to evaluate a single project. Here is an example. Okay, so this nice car, very shiny, very beautiful, right? So this is a car, a model that is, I think it's from Ford, okay? So that is built by the new material called carbon fibers. Okay, if you are a car fan, you might know this new material. It's been developed on the market for a while, but there is a debate. Okay, because we all know that it is lightweight and it's high strength, which means if you use the carbon fibers to make a car, the weight of that car is gonna be much lighter than the car that is made of the normal metal. Okay, the normal metal. So if the car is lighter, that will save the fuel consumption for that car, right? So it is proved that this new material can save 20% to 30% of fuel consumption each year for a car. But another side of this new material is it is very expensive compared to the normal metal material. Okay, so the cost of it is $15 to $20 per pound. Well, so it has two sides. One side is it's very energy saving. Another side is it's costly. So the industry is still having this debate of do we start to change or move on to use this new material for all the future cars, or do we still stuck with the normal metal material? So your question for this to answer is how much more they cost, the materials cost for a car, versus how much more a car made of this can save. So you want to compare this. If you save more, okay, then it's a good deal. If you save less than what it costs, then this is not an acceptable proposal. Okay, so how do you know? How do you compare these two? How do you determine if this is a smart trade-off or not? So this is what we're going to learn for this chapter. This is only one project, okay? So this project is about to use a new material to build a car. And you will know the cash flows, the cost of this new material, the savings of this new material every year, and maybe at the end of the use, you can sell it at a price. So all these cash flows, does it make sense? Does it save you a lot of money? Or what you have paid for the car is over than what you can save every year? Okay, so that is your single project problem, and you want to find a way to evaluate if it's acceptable or not. All right, so here is the summary of this chapter, or we can say it's the motivation of the chapter. So all engineering economy studies of capital projects. Capital projects means you want to invest some amount at the beginning. Right? Like you need to pay for an equipment, you need to pay for some material, you need to at the beginning, at the time zero, you need to spend some money so that you can initiate this proposal. So that's the capital investment. And that type of investment or project, we call it capital projects. Okay? So all engineering economy studies of capital projects should consider the return that a given project will or should produce. So if you want to invest some money at the beginning, you are expecting to have receivings in the long run, in the future time, every year or maybe every month, right? And those receivings should be at least equal to the money you have put into the project at the beginning. That's what we call recover. Okay, so you want to consider if the return, the receivings can cover what you have spent at the beginning. That's the question for every engineering economy study. So so the basic question is whether a project, an investment, and all the expenditures along the timeline, whether they can be recovered by revenue or savings over time. Okay? In addition to a return on the capital that is if sufficiently attractive in view of the risk involved and the potential alternative uses. So, when you make a decision, your objective is to evaluate the return of a single project to see if that return can cover several things. Okay, so the first thing is if it can cover the capital investment. Okay, and second, if they can cover the associated expenditures, like every year you need to spend some money to maintain your equipment or to fix it, repair it, okay, or operate it. And those are the expenditures you need to consider, and they need to be covered or to be recovered. Okay, and third, the risks involved. Well, if you invest in this business, it is possible that the business could go wrong. It could be because the market is not healthy. Okay, it could be because you hired a wrong person. Well, those risks are something you need to take, and you want the profit of that project can somehow recover this risk. Okay, so that's the third thing you want to recover. And the fourth, the potential alternative use of other opportunities. That's the opportunity cost. So besides the capital investment, the associated expenditures, and the risks, you also want to be satisfied by this project because you invested the money into this project, which means you couldn't invest the same amount of money in another maybe better project. So what is gone with you not using the other project is the opportunity cost you also want to recover. Okay, so if you invest in one project, you want to have something payback, you want to have return, and you ideally you want the return to cover all of this stuff so that you will be satisfied, so that the project will be justified. Okay, so this is all about this chapter. You want to evaluate if a single project can recover all of this summed up together. If yes, then that's a good project. You will give it a green light. If no, then you will reject that project and look for another better option. So the contents of chapter 5, you are going to learn 5 different methods that you can use to evaluate if the economic profitability of a single project is good or not. Okay, so the 5 methods, they are present worth method, future worth method, annual worth method. And these 3 methods, they are just to use the methods we have learned in chapter 4. You convert everything to either present or to the future or to every year, and then you wanna you want to compare if that value is bigger or equal to 0. Okay, but the tricky part is if you want to do the conversion, you will involve interest rate. Okay, and in this single problem evaluation, the interest rate is gonna be something called minimum attractive rate of return. So MARR, that's gonna be your interest rate for the timeline. Okay, so MARR is an interest rate. We will explain the MARR later, okay? And I will let you know how do you decide what is the MARR. But you just need to know when you do the conversion using the present worth, future worth, annual worth methods, you convert the cash flow at the MARR, okay? Right, and then you will have your equivalent present value. You compare that with 0, and if it's bigger or equal to 0, then you say this is a good project. You accept that. If not, then you say you're gonna reject that project. Okay, same for the future worth method, annual worth method. You always compare that with 0. Another two methods is called internal rate of return and external rate of return. Okay, so these two methods, the goal is to calculate some interest rate. Okay, so you're going to calculate an interest rate and compare that with your MARR. Okay, you want to see if it's higher than your MARR or lower. If it's higher or equal, then you will say this is a good project because MARR is really your bottom line. It's an interest rate. So you will say my interest rate is, my ideal interest rate, MARR, is 10%. Okay, so any project which can return me interest rate higher than 10% or equal to it, I will say yes. And so that's why you want to compare the calculated I% with your MARR, right? Because that's your minimum attractive rate of return. That's your bottom line. All right, so these are the 5 methods you're going to learn. And then in chapter 6, you are going to use these methods for evaluating the economic profitability of multiple projects. So you're gonna have multiple options, and then you're gonna, convert all of these options back to a present worth or future worth or annual worth or some interest rate. And then you can compare apples to apples. Okay, so that's the contents of chapter 5, and that's why we learn this method, because we're going to use them in chapter 6.